Hey guys, and welcome to my first lecture. If you have any questions, then feel free to ask me at the end of each slide. Here's the current syllabus that I have in mind for today's and future lectures. Let me know if you have any specific topics you'd like me to cover, and I will add it to my list. Each lecture that I will be presenting ties into the trading model I found consistency with, so stay tuned for the final reveal of my model on a future date. In today's lecture, I wanted to cover the unicorn model as this is really what helped me find consistency. And the unicorn model is also one of the strongest algorithmic entry drills. This entry model alone eliminated my overtrading, and it is something I see new traders struggle with, so I wanted to share it with you guys first. For the sake of newer ICT traders, I will also cover what the PD arrays, aka footprints, are required for this entry model. The unicorn model involves fair value gaps, breaker blocks, and order blocks. I've run a backtest for you guys on the mechanical model that will be revealed at the end of this lecture, and the results were extremely promising. Why I love the unicorn model is because once you become fond of it, it doesn't necessarily have to be an entry model, but it can also be a bias tool. From the last 3 months of data, I was able to produce a win rate of 63% and a total of 51% returns on a 100k account. This model will help you guys navigate the lower time frames, as it will most likely not appear if you're on the wrong side of the market. In fact, the mechanical model I will present by the end of today's lecture will often result in a winning trade even when counter trend. So I urge you guys to backtest this and let me know what you find. When looking for inefficiencies in the market, I look for 3 types of gaps: fair value gaps, liquidity voids, and volume imbalances. The main type of inefficiency we will look for in a unicorn model is the fair value gap. The fair value gaps are formations of 3 consecutive candles. A bullish fair value gap is created when candle number 1's wick high does not meet candle number 3's wick low. A bearish fair value gap is created when candle number 1's wick low does not meet candle number 3's wick high. So here you have a bullish fair value gap where this candle number 1, the wick high, does not meet candle number 3's wick low. And here you have a bearish fair value gap where candle number 1's wick low does not meet candle number 3's wick high. Next, we have liquidity voids that are literal gaps in between candles, and their wicks do not meet each other. So here you have a bullish liquidity void where the candle closes and it opens. There's a huge gap here and the wicks do not meet each other. So that would be your bullish liquidity void. And over here you have your bearish liquidity void, which is the same, just flipped around, where the close of the first candle does not meet the open of the second candle and the wicks are not meeting each other. Last but not least, we have volume imbalances. These are also literal gaps between candles, but their wicks are meeting in this case. So here you have candle number 1's close, candle number 2's open, there's a gap between them, but the wicks are meeting each other, so this would be a volume imbalance. Here, a bearish version where the close of this first candle does not meet the open of this second candle, and the wicks are meeting each other, so that would make this a volume imbalance. All of these gaps may be used for the unicorn model, but mainly, once again, we will be using fair value gaps. The next PD array or footprint that we need for the unicorn model is the breaker block. Spotting the correct breaker block is crucial for the success of the unicorn model. Breaker blocks go a lot more in depth as I will be explaining them in this lecture, but what I am teaching here is all that is required for the success of the mechanical model that will be showcased. For now, I will be showing a very mechanical way to spot breaker blocks. This method consists of 2 things: a market structure pattern and identifying the breaker block itself within the market structure pattern. When looking for bullish breaker blocks, we look for a market structure pattern of a low, a high, a lower low, and a higher high. When looking for bearish breaker blocks, we look for a market structure pattern of a high, a low, a higher high, and a lower low. Within this market structure pattern, When looking for a bullish breaker, we look for the highest up close candle prior to the liquidity raid and has been displaced through. So in this case, I have put a bullish candle here that gets displaced through after a liquidity raid. The liquidity raid occurs from this lower low liquidity raids and displaces above this high. Within this high in this liquidity raid, we look for that highest up close candle that has been displaced through. When looking for a bearish breaker, we look for the lowest down close candle prior to the liquidity raid and has been displaced through. So here I've put a bearish candle, the liquidity raid being this high, liquidity raid by this higher high, and afterwards we displace through this low. In this case, you would look for that lowest down close candle prior to that liquidity raid. And in this case, it would be this down close candle I put here. Personally, when seeking a high probability breaker block, I do not want to see price traded back below it or above it. This includes wicking below a bullish fair value gap. So if in this case, if this wicks below, then I would no longer be interested in using this breaker block. Vice versa, in this bearish breaker block, if price wicks above it, then I will be no longer interested in using it. If price does trade back below a bullish breaker or above a bearish breaker, then I will count the breaker as invalid. In this slide, I have created a picture perfect image of breaker blocks. So once again, a bullish breaker, we have a low here, a high, a lower low, and a higher high. So that's the market structure pattern. And price, when price displaces above, it displaces above this high. And so we look for the highest up close candle prior to the liquidity raid. One might ask, why not use this candle right here? Well, that's because price didn't displace through this up close candle. In the case that price does displace through this up close candle, then we could look at it as a breaker block as well. Vice versa, here we have a high, a low, a higher high, and a lower low as the market structure pattern for a bearish breaker. In this case, the lowest down close candle that gets displaced through would be this candle right here, being our bearish breaker. Once again, this down close candle, if it gets displaced through all in this one run, then we could look at this as a breaker as well. Last but not least, we will be looking for high probability order blocks. There are a lot of factors that would make an order block high probability, but for this lecture, I will be focusing on order blocks that are coupled with a fair value gap. The two types of high probability order blocks I will be covering are order blocks that have fair value gaps nested within them. So here you can see this order block has a fair value gap nested within it. And order blocks a part of a fair value gaps formation. So here there's another one where you have this order block and it's a part of that 3 candle formation of this fair value gap. So this would be a high probability order block. Vice versa, this bearish order block has a fair value gap nested within it. So I would look at this as a high probability order block. And this bearish order block has a bearish fair value gap created. So the 3 candle formation, fair value gap, and this order block would be high probability. There are 4 definitions of order blocks that I know, and I use them all in Confluence of the Unicorn model. Before I continue into the definitions of an order block, a bullish order block is always a down close candle, and a bearish order block is always an up close candle. The first definition of an order block from ICT is a series of consecutive candles within a liquidity raid. So in this case, a bullish order block would be all consecutive down close candles within a liquidity raid, and a bearish order block would be all consecutive up close candles within a liquidity raid. The second definition of an order block from ICT is a bullish order block is the lowest down close candle prior to displacement higher, and a bearish order block is the highest up close candle prior to a displacement lower. The third definition of an order block from ICT is a bullish order block is any down close candle when the market is truly bullish, and a bearish order block is any up close candle when the market is truly bearish. Last but not least, the fourth definition of an order block from Casper is a bullish order block is the largest down close candle within a liquidity raid, and a bearish order block is the largest up close candle within a liquidity raid. In a nutshell, all these definitions are valid and are ultimately subjective, but really all we need to understand for the model I am presenting is when bullish, we look for a down close candle that creates a fair value gap or has a fair value gap nested within it, and when bearish, we look for an up close candle that creates a fair value gap or has a fair value gap nested within it. The order blocks will be our stop loss placements and will be explained with examples later. Now, for the fun part, putting it all together. The unicorn model is a breaker block overlapping with a fair value gap, or a breaker block with a fair value gap nested within it. In these examples, the pink box highlights the breaker block, and the gray box highlights the fair value gap. You can see where they overlap together is what price reacts to. So in this example specifically, you have a low, a high, a lower low, displaces upwards, creates a new higher high, displaces through this high, and we look for the highest up close candle for a bullish breaker. In this case, this candle right here would be the highest up close candle. So I highlighted it out in time, and there's also a fair value gap here created, and they're overlapping each other. So look at where price reacts, and that would be the breaker overlapping with that fair value gap and rallies higher. In a bearish scenario, we have a high, a low, a higher high, and then we displace lower through this low to make a lower low. So in this case, we look for the lowest down close candle prior to that liquidity rate, which is of this high. So in this case, this down close candle would be the lowest down close candle. And so I've highlighted it as the breaker. Drawing it out in time, we have this fair value gap that's overlapping with the breaker. And look where price reacts to it, where the breaker overlaps with the fair value gap. In this slide, I annotated where the fair value gap is nested within the breaker block. Once again, the pink box highlighting the breaker block and the gray box highlighting the fair value gap. So in our bullish scenario, we have a low, a high, a lower low, and a displacement upwards of this higher high. So if you look for your bullish order block, the highest up close candle prior to the liquidity raid would be this one right here. And so I highlighted it out in time, and there's a fair value gap nested within this breaker block. So where does price react to it? Where they are overlapping each other, and price rallies higher. Vice versa, in a bear scenario, we have the high, low, higher high, and displacement down through this low to make a new lower low. So in this case, we look for the lowest down close candle prior to the liquidity raid, and that would be this candle right here. So I've drawn it out in time with the breaker, and we have fair value gap nested within it. Where does price react to this unicorn model? Where the breaker and fair value gap are overlapped with each other, the market displaces lower. The model I will be providing has only been backtested on indices, but the unicorn model is universally applicable to all markets as well as all time frames. When trading Forex, I typically like to hunt for setups to form between 8 a.m. to 12 a.m. New York time. For this model, we will wait for the unicorn model to present itself on the 5-minute time frame during 9:30 a.m. to 11:10 a.m. New York time. If you are able to get a setup pro trend of the higher time frame, that is ideal. The entries of this model will be limit orders set at one of two places when the unicorn model presents itself. 1. Limit order at the breaker overlapped with a fair value gap. And 2. Limit order at the fair value gap nested within the breaker block. The stop loss will be placed at the candle body low of a bullish high probability order block and at the candle body high of a bearish high probability order block. For this mechanical model, we will be targeting a fixed 2R. As you become more advanced with the unicorn model, there will be more discretionary ways to take profit, but for now, fixed 2R. Before each trading session, I recommend getting to your desk earlier than the intended trading window, as you want to be prepared and tuned into the market. For this mechanical entry model, I recommend getting to your desk at 9 a.m. latest, so you have time to do a quick chart markup and to determine your higher time frame bias. For chart markup, there will only be one type of annotation required, and that would be the vertical lines. For vertical lines, every morning plot a vertical line at 9:30 a.m. and 11:10 a.m. New York time. Now, let's get into some of the examples with this entry model in action. I'll be using examples of my A+ playbook trades that I took live and explain why I took these trades. Example number 1 is a trade I took on ES September 1st, 2023. Starting on the daily time frame, I saw that external buy-side liquidity was rated, so I immediately turned my attention to the internal range liquidity as the next draw on liquidity. Majority of my framework was done on the hourly chart. During the session, I was expecting buy-side liquidity to be rated, creating a turtle soup for my short entry. As my weekly objective had been met, I was expecting a TGIF setup, meaning that price would retrace back into the 20 to 30% of the weekly range. Once my buy-side liquidity target had been reached, I dropped down to the 5-minute time frame to hunt for an entry. From the 5-minute time frame, I draw my vertical lines from 9:30 a.m. to 11:10 a.m. New York time, and I now have my higher time frame narrative that we are likely to trade lower. Since my bias was bearish, I looked for a bearish unicorn model to present itself, and once it did, I took the trade. My entry was where the breaker overlaps with the fair value gap, which would be right here, where you can see the pink box is the breaker and the gray box is the fair value gap, and where the breaker overlaps with the fair value gap, that was my entry right here. Then I placed my stop loss above the high probability order block. So in this case, the high probability order block would be this up close candle right next to my cursor, as it is one of the candles in this fair value gap creation or formation. So candle number 1, candle number 2 trades down, and candle number 3, creating that fair value gap. And because this is an up close candle, that would be my high probability order block. My stop loss is on the candle body high. The reason I placed a stop here is because it is protected by 3 high probability PD arrays or footprints. On my actual trade, I targeted the equal lows, but for these examples, I will be showing the 2R take profit as it is more consistent. In this slide, I show what I targeted on my actual trade. I targeted the equal lows that align with my projections at 20 to 30% of the weekly range for a TGIF setup. Example number 2 is a trade I took on ES September 4th, 2023. Starting on the daily time frame, I saw that the same external buy-side liquidity was rated, so I immediately turned my attention to the internal range liquidity that has still yet to be tapped into as the next draw on liquidity. One thing I do want to note is that this was Labor Day and trading hours were shortened until 12 p.m. New York time. I took this trade because it just looked too good, and once we dive deeper into the lower time frames, I'll really showcase why it looks so clean to me. Once again, majority of my framework was done on the hourly chart. During the session, I was expecting further bearish price action as the previous trade example created a bearish market structure shift at a key higher time frame level. When I got to my desk, I saw that 6 a.m. and 8 p.m., which would be these two candles here, these bearish candles, price had reacted bearishly to the open price of the hourly bearish order block, indicating that there was a change in the state of delivery. This gave me a lot of conviction to look for a short. I then dropped down to the 5-minute time frame to see if I had an entry. From the 5-minute time frame, I draw my vertical lines from 9:30 a.m. to 11:10 a.m. New York time, and I now have my higher time frame narrative that we are likely to trade lower. Since my bias was bearish, I looked for a bearish unicorn model to present itself and spotted one that formed right before my trading session began. So that would be over here. It formed as my trading session began. That would be my trade window. My entry was the fair value gap that is nested within the breaker block, which would be this breaker block here. And there's also a fair value gap here. And within here, I put my limit order on that fair value gap that's nested within it. I place my stop loss above this high probability order block, as this is, once again, creating that fair value gap, as well as having that fair value gap nested within it. So I place my stop loss at the candle body high. Once again, the reason I placed the stop here is because it is protected by 3 high probability PD arrays or footprints. So in this case, we have the breaker, fair value gap, and once again, that high probability order block. In this slide, I show what I targeted on my actual trade. I targeted the equal lows that align with my projections at the -2 and -2.5 standard deviations of the most recent liquidity raid. So in this case, this liquidity raid is what gave me my unicorn model. So this is the manipulation I'm looking at projected out in time. We have 1, 2, 3, 4, 5, 6 equal lows right here. That was a very clear target to me. Over here, we had another 5 equal lows. So you could have targeted that as well. I chose this one because it was between the -2 and -2.5 standard deviations. The final example is a trade I took on NQ September 26th, 2023. Starting on the daily time frame, I saw that NQ had been reaching for the relative equal lows, which is also a monthly imbalance. In additional confluence, the seasonality during this time of DXY was bullish, meaning that indices were bearish. Initially, I was bullish heading into this day as external range liquidity had been run out, causing me to expect internal range liquidity. But as I dissected price on the lower time frames, it became clear that the relative equal lows were the draw on liquidity. Once again, majority of my framework was done on the hourly chart. During the session, I was expecting further bullish price action as the daily external range liquidity had been purged. When I got to my desk, I saw that at 4 a.m. and 8 a.m., price had reacted bearishly to the buy-side liquidity raid of Asia and London session highs within an hourly unicorn model. This is what I meant by the unicorn model is not only an entry model, but can also determine bias. With this new bearish idea in mind, I dropped down to the 5-minute looking for a bearish unicorn to form. From the 5-minute time frame, I draw my vertical lines from 9:30 a.m. to 11:10 a.m. New York time, and I now have my higher time frame narrative that we are likely to trade lower. Since my bias was bearish, I looked for a bearish unicorn model to present itself and spotted one that formed during my entry window. My entry was a breaker block overlapped with a fair value gap, which would be this breaker block up here. You have a high, a low, a higher high, and a displaced lower below this low, creating that breaker block, which would be the lowest down close candle prior to the liquidity raid. My stop loss was once again above the high probability order block, so that would be this up close candle that has a fair value gap in confluence with it. So this up close candle and this fair value gap that overlaps with it. My stop was at the candle body high of this up close candle. Once again, the reason I placed the stop here is because it is protected by 3 high probability PD arrays or footprints. In this slide, I show what I targeted on my actual trade. I targeted the daily equal lows as that was the only thing that aligned with my projection. Although price traded into equal lows, I closed my trade at a 2.6 R since the prop for my trade width requires all trades to be closed by the end of day. So that brings me to the conclusion of this lecture covering the unicorn model. I hope you all find this insightful, and if you have any questions, feel free to ask me. As always, have a great day.